everyone, you're welcome to this week's Business and Investment Tips program, a production of Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the impact of rising inflation on the interest rate environment. Last week, the National Bureau of Statistics, NBS, released the Consumer Price Index report for August 2022. The Consumer Price Index, CPI, is used to calculate inflation as it measures the average change over time in the prices of goods and services consumed by people for day-to-day living. Based on the report, inflation rose to 20.52% year-on-year in August 2022, its highest level since 2005 from 19.64% year-on-year in July 2022. On a month-on-month basis, however, inflation slowed to 1.77% versus 1.82% in July. This is the 8th consecutive increase in the inflation rate caused by supply-side pressures and the pass-through effect of the currency depreciation. It is, however, important to note that the moderation in monthly inflation may indicate that inflationary pressures are gradually abating, likely due to easing energy costs and the start of the harvest season. Although it is expected that the low base from last year should continue to impact CPI numbers in the coming month. Food inflation, which is the biggest driver of headline inflation, reached 23.12% year-on-year, up from 22.02% in July. Core inflation, which removes the impact of the farm produce and energy, rose to 17.20% year-on-year from 16.26% year-on-year in July. As inflation rises, the Central Bank of Nigeria, CBN, often try to control it by raising interest rates. When the CBN raises its interest rates, the yields on fixed income securities and other interests typically rise as well. Recently, the Monetary Policy Committee, MPC, of the CBN, the highest decision-making body of the institution, raised the monetary policy rate, MPR, by a combined 2.5% at its last two meetings in the effort to curb inflation. This, coupled with the unconventional policies by the CBN, has contributed to an increase in fixed income yields. Consequently, the average T-bills and bond yields have advanced by 3.4% and 1.35% to 7.80% and 12.64% since the start of the year. Also, when investors worry that yields in the fixed income space won't keep up with the rising cost of inflation, the price of the bond drops and the yield rises, as investors sell off their existing investments and buy newer instruments that offer higher yields to compensate for rising inflationary pressures. While inflation is still above the potential returns on bonds and T-bills despite rising yields, investors are in a much better position than earlier in the year. Consequently, investing in high-yield fixed-income investments such as commercial paper, bank placements, and FGN savings bonds lowers the impact of the inflation on your investments, thereby enhancing your buying power. To learn more about the opportunities in the Nigeria's fixed income space, kindly listen to our podcast on investment in fixed income securities. In addition to the accelerating inflation, a persistent decline in the value of the naira impacts your investment. Therefore, it is advisable to have a significant portion of your investments in dollars. You can also check out our podcast on investing in dollar-denominated assets to understand the investment process and the opportunities. Thank you for listening. Please join us same time next week for another interesting and insightful session. For comments and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.